Exercise 4-17, we're going to create a classified balance sheet. So the adjusted trial balance of Penny O'Hara Dance Studio Company follows. So here is our trial balance. Notice the order of all trial balances are assets, liabilities, capital and draw, revenues, then expenses. So our job is to prepare the classified balance sheet of Penny O'Hara Dance Studio Company as of August. Use the report form. Report form just means you have assets on top and then liabilities and equity are below that. The account form, you would have the assets on the left and liabilities and equity on the right. But we're going to do the report form. You must compute the ending balance of O'Hara Capital. So begin by preparing the asset section of the balance sheet, then prepare the liability section, and finally the owner's equity section. So the purpose of this assignment is to give you practice creating a classified balance sheet. So from now on, whenever we create balance sheets, they will be classified. All that means is we're going to take the assets, we're going to classify them into current assets, which are assets, let me put in the label. Current assets are assets that you expect to be used up or converted into cash within the next 12 months. And then the other assets are long-term assets, ones that you do not think will be converted into cash or used up within the next 12 months. Now, the long-term assets are never called long-term assets. They're called plant assets or fixed assets or property, plant, and equipment. This company calls them plant assets. So again, we have two types of assets. Current assets will go here, and then our plant assets go here. So let's figure out which of these assets are going to go under current assets. So again, current assets are assets that you expect to be used up or converted to cash within the next 12 months. So cash is already cash, so that is obviously a current asset. Next, we got office supplies. Most office supplies are going to be used up within the next 12 months. So that is a current asset. Prepaid rent is usually used up within the next 12 months. You usually do not prepay for more than 12 months of rent. So we will include that in our prepaid or our current assets. All right, so, oops. I messed up. This is not, the label for our plant assets goes down here. What we need here, notice we have this line. This line we need to do some math. We're going to add these up and put the subtotal here. So this will give us total current assets. So we're going to add up 14,400 plus 2,600 plus 1,400. That gives us what? About 18,400. Now we're going to go down. I'm going to scroll down. Now we need our plant assets. So we got cash, office supplies, prepaid rent. So now we've got equipment, $54,000. That's how much the equipment cost us. And then whenever we have an asset that depreciates, right next to it will be its accumulated depreciation account. So accumulated depreciation is $5,400. And that's all. Notice that's our last asset over here in our list of assets and other accounts. So we're going to have total plant assets, and the way we're going to calculate that is 54,000 minus. Remember, accumulated depreciation is a contra asset, so it lowers the value of this asset called equipment. And also, here's another reminder that what to do with it. Less means to subtract. So 54,000 minus 5,400 gives us 48,600. And now we're going to have total assets. So to get that, we're just going to add 18,400 plus 48,600 gives us what? About $67,000. Check our answer. Well done. All right, now liabilities. So liabilities, we're going to split them up or classify them into current liabilities and then long-term liabilities. So a current liability is a liability that you expect to have to pay within the next 12 months. So let's find our liabilities. Our first one is accounts payable. That is usually due within 30 days, so obviously that is a current liability. Next, we've got salaries payable. You will have to pay your salaries payable within probably 2 weeks if you got pay periods of 2 weeks. So that's obviously also a current liability. Salaries payable. And then our unearned revenue, $4,900. That is also a liability. Remember, unearned revenue just means we've been paid ahead of time for someone, so we need to provide them with that service to get rid of that liability. And our customers are going to expect us to provide that service within the next 12 months. So now we've got this line here, which means we need to do a subtotal. So we're going to take 4,100 plus 800 plus 4,900 gives us $9,800 of current assets. So this is total current liabilities. Now we have a long-term liabilities. So our long-term liabilities, the only one we have here is we have a notes payable because it has the word payable in it. It means it's a liability. And notice it says long-term. So there are sometimes part of a note payable is short-term, but this is all long-term. If part of it was short-term, you would put the short-term part of it in the current liability section. So current liabilities long-term, $4,900. And then notice we've got this horizontal line, means we need to do a subtotal. So we're going to take $9,800 of liabilities, current liabilities, add the long-term liabilities. That gives us what, $14,700 of total liabilities. Excellent. Now, owner's equity. Note, you cannot use this capital amount, $44,000. If you did, the balance sheet would not balance. $44,000 plus total liabilities does not equal $67,000. And remember, the instructions told us we need to compute the ending balance of O'Hara Capital. So the proper way to calculate the capital on the balance sheet, let's review the formulas for the three financial statements. So you do the income statement, revenues minus expenses gives you net income. And then we do the statement of owner's equity, and that will give us ending capital. And notice it's the ending capital that goes over here on the balance sheet. So how do we calculate ending capital? Well, we have to take the beginning capital, add the investments, and calculate net income, add net income, and then subtract draws, and that gives us ending capital. Now they do give us the revenues and expenses and the draws. So we could calculate net income by taking $16,500 and then subtracting all of these expenses, and then we'd have to subtract the draw, and then the beginning capital and plus the investments would have been $44,400. But in this problem, that's a long ways to go when all you really have to do, since we know that the balance sheet formula is, again, assets equals liabilities plus ending capital, we can figure out this capital amount by figuring out $14,700 plus what equals $67,000. So all we need to do is subtract those two. So we got 67,000. We're going to subtract 14,700. Gives us $52,300 of capital. And that's O'Hara capital. And then this final line is total liabilities and owner's equity. Double check your work. Does 14,700 plus 52,300 equal 67,000? Yes, it does. And our balance sheet balances. Requirement 2, compute O'Hara's current ratio as of the end of August. 1 year ago, the current ratio was 1.57. And then we need to figure out if it's improved, gotten worse, or remained the same. So first of all, we have to know, well, what's the formula for the current ratio? As you probably recall, hopefully recall, the formula for current ratio is total current assets divided by total current liabilities. So what it's trying to measure is it's trying to compare how much current assets do you have to pay off your current liabilities. So let's plug in total current assets. So to get that, we're going to scroll up. Total current assets are right here. So we got $18,400. And now we need total current liabilities, $9,800. And we're going to do the math and then round our answer to 2 decimal places. So 18,400 divided by 9,800 equals 1.88. Cool. So what this 1.88 means is that for every dollar of the thing on the bottom, the denominator, so in other words, for every dollar of liabilities, they have $1.88 of current assets with which to pay off those current liabilities. Obviously, you want this current ratio to be 1 or higher. And finally, since the current ratio was 1.57 a year ago, Penny O'Hara's ability to pay its current liabilities has it gotten better, gotten worse, or stayed the same? Well, we want this number to be high because we want a whole bunch of current assets and very little liabilities. And it was 1.57. It's now 1.88, so it's gotten better. It's improved. And that's it.